Hey everyone, and welcome back to the channel. Today, we re-tackling a topic that so many of you have asked about: how to start investing in shares. It might sound intimidating, but I promise by the end of this video, you'll feel much more confident about taking your first steps into the world of investing. So, grab a notebook and let's demystify the stock market together. First things first, what exactly does investing in shares mean? When you buy a share, you're buying a tiny piece of ownership in a public company. Think of big names like Apple, Amazon, or maybe even your favorite local company that's publicly traded. As the company grows and becomes more profitable, the value of your share can increase. It's like owning a tiny slice of a giant, growing pie. The goal is to buy these slices when their price is low and sell them when the price is higher, or hold onto them for the long term and benefit from the company's growth and potential dividend payouts. Now, before you jump in and start buying, there's a crucial first step: defining your financial goals. Why do you want to invest? Are you saving for a down payment on a house in 5 years? Planning for retirement in 30 years, or maybe you just want your money to grow faster than it does in a savings account? Your goals will determine your investment strategy. A short-term goal, like that house deposit, might require a less risky approach than a long-term goal like retirement, where you have more time to ride out the market's ups and downs. So, take a moment to really think about what you're working towards. Write it down. It makes it real. Next up, let's talk about something called risk tolerance. This is just a fancy way of asking, how comfortable are you with the idea of your investment value going down temporarily? The stock market doesn't just go up in a straight line, it fluctuates. Some people are totally fine with seeing their portfolio drop, knowing it will likely recover over time. Others might lose sleep over it. There's no right or wrong answer here. It's all about your personal comfort level. Be honest with yourself. Understanding your risk tolerance will help you choose the right types of investments that won't give you a heart attack every time you check your account. Generally, younger investors with a longer time horizon can afford to take on more risk for potentially higher returns. Alright, with your goals and risk tolerance in mind, it's time for the exciting part. How do you actually buy shares? You can't just call up a company and ask for a share. You'll need to open an investment account with a brokerage firm. Think of a broker as the middleman that connects you to the stock market. There are many different types of brokers out there. You have traditional full-service brokers who offer personalized advice, but usually come with higher fees. Then, you have online discount brokers, which are incredibly popular today. These platforms, like Fidelity, Charles Schwab, or Vanguard, allow you to buy and sell shares yourself through a user-friendly app or website, and they often have very low or even zero commission fees for trades. For most beginners, an online discount broker is the perfect place to start. The sign-up process is usually straightforward, similar to opening a bank account online. You'll provide some personal information, link your bank account to transfer funds, and you'll be ready to go. Once your brokerage account is set up and funded, you face the big question: what shares should you buy? This is where a lot of people get stuck. My advice for beginners is to start simple. Don't try to find the next big thing or time the market perfectly. Instead, consider starting with something called an exchange-traded fund, or ETF. An ETF is like a basket that holds hundreds or even thousands of different shares from various companies. For example, you can buy an S&P 500 ETF. By buying just one share of this ETF, you are instantly invested in the 500 largest companies in the US. This is a fantastic way to achieve instant diversification. Diversification is key. It means not putting all your eggs in one basket. If one company in your ETF performs poorly, it's balanced out by the hundreds of others that are doing well. It's a much safer and more stable approach than trying to pick individual winning stocks, which even professional investors struggle with. If you do want to invest in individual companies, start with what you know. Look at the brands and products you use and love every day. Do you always buy Nike shoes? Do you have the latest iPhone? Is your morning coffee always from Starbucks? These could be great starting points for your research. When you research a company, you're not just looking at its stock price. You want to understand its business. Is it profitable? Does it have a strong competitive advantage? Is it growing? Look at their annual reports, read news articles, and understand their industry. Investing in businesses you understand makes the process less intimidating and more engaging. Now let's talk strategy. Two of the most common approaches are lump sum investing and dollar cost averaging. Lump sum is just what it sounds like. You invest a large amount of money all at once. If you have a big chunk of cash ready, this can be effective as historically, markets tend to go up over time. However, for most of us, dollar cost averaging is a more practical and less stressful strategy. This involves investing a fixed amount of money at regular intervals, say $100 every month, regardless of what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices are low, that same amount buys more shares. Over time, this averages out your purchase price and reduces the risk of investing a large sum right before a market downturn. It's a disciplined approach that takes the emotion out of investing and helps you build wealth steadily. You can often set this up automatically within your brokerage account, making it a set it and forget it strategy. Okay, so you've opened your account, you've chosen your first investments, and you've started putting money in. What now? The most important and sometimes the hardest part of investing is to be patient and think long term. The stock market is not a get-rich-quick scheme. It's a tool for building wealth over years and decades. There will be good years and bad years. The news will be full of scary headlines trying to make you panic and sell. Don't. Remember those goals you set at the beginning. Keep them in mind. The power of compounding, where your earnings start generating their own earnings, is a magical force, but it needs time to work. Albert Einstein supposedly called it the eighth wonder of the world. By staying invested through the ups and downs, you give your money the best possible chance to grow significantly over the long haul. Check on your portfolio periodically, maybe once a quarter, to make sure it's still aligned with your goals, but avoid the temptation to check it every single day. This will only lead to stress and emotional decision-making. So, let's recap the key steps. 1. Define your financial goals and your timeline. 2. Understand your personal risk tolerance. 3. Open an account with a beginner-friendly online broker. 4. Start with diversified, low-cost investments like ETFs, or research individual companies you know and believe in. 5. Be consistent with your contributions using a strategy like dollar cost averaging. And 6. Be patient, stay the course, and let the power of compounding do its work over the long term. Starting your investment journey is one of the best financial decisions you can make for your future self. It's about taking control of your financial destiny and building a more secure tomorrow. You don't need to be an expert, and you don't need a lot of money to start. You just need to take that first step. I hope this guide has made the idea of investing in shares feel a lot more achievable. If you found this video helpful, please give it a thumbs up. It really helps the channel grow. And don't forget to subscribe and hit that notification bell so you don't miss our future videos on personal finance and investing. If you have any questions, drop them in the comments below. I'll do my best to answer as many as I can. Thanks so much for watching, and I'll see you in the next one.